Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Empire Fintech Conference in New York City. Joining us for this segment, we have Olga Chin. She's the CEO of InterPrice Technologies to discuss how CFOs and treasurers think about funding plans and balance sheets in the current environment. Olga, it's great to have you with us. Welcome to Trade Talks.
Of course, happy to be here.
You got it. InterPrice, you work with many global corporate treasury teams. Tell us more about the corporate treasury space.
Sure. So, when people think of the word treasury, usually they imagine a couple of guys sitting in like a dark vault counting stacks of dollar bills. Not the case. Corporate treasury teams are incredibly sophisticated professionals. It's usually like a hybrid of, banker, trader, accountant, risk manager kind of rolled into one. And so what do? They manage a lot of the cash and investments, so that's there, but they also manage a lot of the interest rate risk, foreign exchange risk, liquidity. They also handle financial reporting, regulatory compliance, and that role has actually become a lot more complex as we have new financial instruments being introduced and just the overall volatility in the market. So just to give you a couple of examples, we have clients who fund cross-border transactions overnight in 3 different markets. We have clients who fund in the commercial paper space every day. So that's kind of corporate treasury in a nutshell.
So let's talk about the current environment, right? We're in higher interest rates, certainly in a more volatile marketplace. How do CFOs and treasurers think about their balance sheets at this time?
Very topical question. So on the positive side, a lot of companies are actually flush with cash. So it's great for them. They can earn higher return on their investments. On the flip side, of course, just to state the obvious, higher interest rates means higher cost of capital across all the companies. So from that perspective, it's for everybody else. I remember 2-3 years ago as a former banker, companies used to fund 30-year bonds at 2% interest rate. An amazing thing for a CFO or a corporate treasurer to put on the resume, super cool. No longer the case at all. And so what companies are struggling with is saying, well, if I am going to be in this higher interest rate environment for maybe not that much longer, maybe the Fed is going to pause the hikes, do I fund now and actually take the risk of it, or do I wait and do I bridge it with some kind of short-term investments? A lot of people are also swapping to floating, but the reality, the most interesting thing to me was the corporate treasury teams have been really surprised by how fast the rate hikes actually happen. So from that perspective, we've all talked about it for years, but it was almost like Bigfoot. Everybody talks about it, but nobody has seen it until very recently. So it was like the speed of the rate hikes that actually took a lot of treasurers by surprise.
Well, I mean, it was 500 basis points in a matter of 9 months. I mean, that's shocking. We've been talking about Silicon Valley Bank here and other bank failures. Was there any impact on InterPrice or any of your clients?
So thankfully, InterPrice has not been directly impacted. Our banking relationships mirror our companies, our clients' banking relationships. And since we work with some of the largest companies in the world, they tend to not to be the usual targets for SVB. But having said that, I think the whole situation actually brought, the counterparty risk into perspective, that it's real, it's present. 2-3 years ago when I first started InterPrice, nobody was talking about bank health monitors, credit ratings, so the banks or CDS monitors. Now that gets brought up in every single conversation. And so that's been a change, and I actually think that's very much needed.
Yep. I agree with you, and I also think this valuation reset that we've seen in the public and private markets were certainly needed. There's a lot of lessons to be learned here, especially for younger management teams when it comes to balance sheet and governance and so forth. So to your point, a lot of lessons to be learned. Nasdaq Ventures co-led your Series A along with a DRW at the end of last year. This is the first ever investment from Nasdaq to a female-founded and female-led company. Tell us what that means for you and your team.
So I'll address the female-led company in a second, but for us, partnering with Nasdaq Ventures and DRW Ventures is tremendous. We are incredibly grateful for that, and we take pride in it. First of all, it provided us with added capital to actually provide enterprise-level products to some of these like Fortune 500 companies and their banks. So that's been pretty huge. And of course, for us, trust and security is a critical component of the business. So having even the official support of Nasdaq is incredibly important. Now, I don't know if I'm honestly the very, very first, but one of the first female-led companies funded by Nasdaq. And to me, that's pretty important. Look, I am well aware that 3% or less, or whatever statistics are, of capital goes to female-led companies, and I want to change that. And for us, the really cool thing is, we have Kim Childman from DRW on our board. We have the treasurer of Nasdaq, Dana Leithold, on our board as well, which means that we have a predominantly female-led board of directors, which is also incredibly unusual. So for me personally, it's really important, and so I want to change that.
There's a lot of female leadership tech talent here, that is for sure. Appreciate the insight. Olga, thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.